study in the 10 is inventory. How do companies generate profits? Again, this is revision. You've actually covered inventory in 1501. It's just applying it to 1502. Mainly recap.
Okay. Well, you determine your profit by deducting your cost of sales.
How do we generate a profit, though? How do we generate a profit?
You add a certain percentage to the cost of the sale.
Correct. Okay, so you're focusing on buying and selling goods or rendering a service. What are we focusing on here? The goods or the service? The goods or the services?
Goods.
Exactly. Okay, so when looking at inventory, the focus is on the sale part. Okay, so what do we need to sell? Well, we either need goods that we're going to manufacture, or we're going to have goods that we're going to buy and sell. If I have manufactured goods, then I'm going to have raw material, I'll have work in progress, and I'll have the actual finished product. So inventory can be grouped into different stages: raw material, work in progress, finished product. But I'm going to be using it to sell. Okay, I'm going to sell something in order to generate a profit. Okay, your sales minus your cost of sales. Here's the two different systems which you mentioned earlier. What's the difference? Well, perpetual means continuous. So what type of business will be using this? Well, businesses that have few items. Okay, where you're not going to have too many. Okay, so in your company, would you use perpetual or periodic?
Perpetual.
Definitely. Okay, because you guys are selling larger items of equipment. You're not selling quantity. Okay, so you'll know exactly what the item costs. You'll know how much you're going to sell it for. You'll know how much the profit is. Okay, and that's why cost of sales is accounted for all the time for that system. Periodic, you don't have a cost of sale. Why? Because it's just too much effort.
Yeah.
Can you imagine selling hundreds or thousands or millions of different items?
Yeah.
Very, very difficult to keep track of every single item. Okay, so that's collective. So we're going to do a stock take, and we're going to keep track of inventory, but as a summary. Okay, we're going to summarize cost of sales in terms of opening stock, closing stock, purchases, and so on. Okay. Right, so inventory needs to be accurately accounted for. We know that. It's important because we're going to be buying it to sell it. So if inventory is going to be managed appropriately, what are some of the different scenarios that you could get? There's a lot that you could think of, but just give me a few examples. Different transactions that would involve inventory. Buying it, selling it, that's two.
Stock take.
Counting it, yeah.
Not sure.
Are you always happy with the stock that you buy?
Oh, you can return it as well.
And can the customers?
Yes.
Okay, so sales returns, purchases returns. What else? Does the owner take stock for their own use? They could.
They could.
Drawings. Could they donate stock?
Yes.
They could. Okay, so there's a lot of different scenarios. It doesn't matter what the scenario is. Obviously, inventory is going to be considered an asset. Okay, so when looking at the recording of its value, or its worth, we're going to be looking at historical cost. If we're looking at historical cost, we're looking at the value of the stock in the past when I
When you
bought it.
Okay.
Exactly. Can I change the cost price?
No.
No. But what is the cost price going to include? Well, all delivery, setup, purchase costs that are part of the actual stock. Because remember, I need to buy the stock before I can sell it.
Yes.
So if I need to pay for the transport, is that going to be included in the cost price?
Yes.
It has to. Okay, it needs to be recovered somewhere. Okay, so the business is going to include things like transportation, import, export, insurance, handling, etc. Okay, so from 1502, you looked at historical cost. Here we're looking at the buying and selling of stock, and we're looking at the costs that are associated with the purchase. If I'm a VAT vendor, is that going to change the way I record stock? How would it?
Okay, yes, because you have to add your VAT to the product so that you can get the VAT from the clients to give it to Sash.
Correct. Okay, so if you're paying VAT on the goods that you've bought, is that good or bad?
Bad.
No, it's good. Why? You get to claim it.
Oh, okay, yeah.
Right, so the more VAT that you pay, the more VAT that you'd be able to claim. Right, so if I'm looking at buying goods, what would the cost of the assets be in terms of stock? What would I record the stock at? VAT exclusive, VAT inclusive? What would I use to record the actual
VAT
VAT?
inclusive.
If I'm a VAT vendor, a VAT vendor can claim the VAT.
Yeah.
So what would their cost price be?
Oh, the exclusive.
The exclusive amount, exactly. Okay, so for a VAT vendor, if you buy stock, you're going to buy stock at a VAT inclusive amount, but you claim the VAT. So because you claim the VAT, I'm going to show the VAT exclusive, because this would be seen as an asset for the business. Something that the business is going to claim as a benefit. So if I'm a VAT vendor and I'm buying stock, stock will be seen as being slightly cheaper because it'll be at 100%. It'll be the VAT inclusive minus the VAT, gives you the VAT exclusive. Okay, that's the amount that I'm going to be using to record in my books. Okay. For a non-VAT vendor, what would the cost be? Exactly. Okay, so there you'll have VAT inclusive, meaning inventory will be debited and bank or creditors will be credited. There will be no VAT shown separately. And so the full amount is going to be part of the business's recording of inventory or stock.
Okay.
Make sense?
Yes.
Okay, then we've got a note about first in, first out, last in, last out, weighted average. Again, this is more management accounting. Management accounting is more specific in terms of decision making, so we need more detail. When looking at financial accounting, you don't have to worry about this, okay, because financial accounting is just going to look at what is the value of the stock, right, from a higher level. We're not going to dig too deep in terms of what are each of the items worth. What am I using? First in, first out, last in, last out, or weighted average. Right, so when looking at inventory, it's literally just going to be what is the total cost of the inventory that I have in the business. That's all. Okay. Alright, the next bit here is looking at gross profits. Do you remember how to calculate markup, cost, price, selling price? Those type of workings. Okay, that is something that you might have to do depending on the level of difficulty in the question. Right now, we're just looking at calculating an amount based on what we've got. So, is it possible to complete a stock take? Not always. Okay, so for example, you guys had to do some investigation because you had some stock that you couldn't account for. Okay, so that requires a stock take, and then you can't find the stock, there's a missing amount, so you have to estimate. Okay, and then you might use the gross profit percentage to estimate how much stock you were supposed to have. Right, so if sales is 100 and cost of sales is 60, gross profit would be 40. It's the difference between the two. Right, when looking at gross profit percentage, what would that be? It's a percentage. So gross profit percentage, meaning gross profit over sales, 40%. That's the gross profit percentage. It's the amount that I'm deriving it as a profit divided by the 100, okay, which is representing the sale. Okay, then that's 40%. Gross profit will therefore be what? Well, we can then say gross profit is sales minus cost of sales, right? So sales minus cost of sales is going to give me a gross profit figure. If I'm multiplying sales with the gross profit percentage, I'm going to get the 40. So it's like working backwards and forwards. Right, so there I had a fraction, okay, 40%, and then I could estimate gross profit and cost of sales based on it. Right, so if I knew the gross profit was 40%, I can get the cost of sales, which comes out to 60, because sales minus gross profit would be the cost of sales. Right, so in certain scenarios, we can estimate cost of sales. This is looking at incomplete records. In your study guide, the final chapter is incomplete records. Incomplete meaning you're missing information. Right, so sometimes when you look at exam pass papers, sometimes they give you missing figures, and then you've got to find the missing amount. Okay, that requires calculations sometimes, or equations.
Sorry,
Okay, so in the exam, sometimes they don't give you all the correct amounts. Sometimes they give you missing figures, and if there are missing figures, you've got to calculate and solve. Right, and you've got to find those missing amounts.
Okay.
Right, so it can be problematic if we don't have all the correct information. Right, then I need to substitute and solve. Okay. Right, so just an exam tip. Are you going to be told what system is in the exam paper, in the question?
No, you need to be able to identify.
So how do I identify? How do I know if something is perpetual? How do I know if something is periodic?
Perpetual is the cost of sale.
Correct.
And periodic is like stock take. You need to literally.
Yeah, well, you won't see the stock take.
Okay. Then you don't. I don't know.
What's the vocabulary used to describe inventory with periodic?
Inventory.
No, we don't call it inventory with periodic. Perpetual you call inventory.
Okay.
What do you call inventory with periodic?
Stock.
No.
I don't know.
Purchases. Remember that?
Yes.
Okay. Purchases. Right, so how will I know if they're using periodic? Just look for the word purchases. Okay, or carriage on purchases. Anything with purchases. That refers to the periodic system. Right, disclosure is key. So do you agree there's always an easy mark? What do I disclose in the statement of financial position? The closing balance for inventory. Okay, because remember the statement of financial position is going to tell me how much I have left. Right, does that make sense? Okay. Right, so we need to revise this. We actually covered in study unit 7, but it might be some time ago, so you might have maybe forgotten some of these things. Let's start with the first bit, profits. How do I calculate it?
It's income minus expenses.
Correct. Okay, income minus expenses. And I get two different types of profit. What profit do I calculate in the trading accounts? Trading means buying and selling, right?
Yeah.
So what profit will I have from buying and selling? Gross profits. Okay, gross profit means I have a sale and I have a cost of sale. Exactly. Okay, what profit will I have in the net profit? Oh, well, I actually gave it to you. What profit will I have in the profit and loss?
Net profit.
The net profit. Okay, and how do you calculate net profit? It's taking other income and other expenses into consideration. Okay, so with perpetual you'll have cost of sales, with periodic you won't. Right, for both types of businesses, it doesn't matter which one, perpetual or periodic, I'm going to have a cost of sales because I'm either going to calculate it or I'm going to record it or take it from the actual books of the business. Right, gross profit comes from trading account, net profit comes from profit and loss, taking other income and expenses into consideration. Okay, so there's a note about the gross profit. What is it? It's sales minus cost of sales. That's the trading account. Right, so what type of account is sales?
It's income.
Correct. So if it's income, what balance will it have?
A credit balance.
Exactly. So even in the trading account, it'll still be on the credit side. Okay, you're referencing it because you're closing off the sales and you're closing it to the trading accounts. Okay, cost of sales. What type of accounts?
It's an expense.
Correct. So if it's an expense, yes, if it's an expense, it's going to have a debit, exactly. Right, so your cost of sales will be on the debit side. Right, and what do you notice? Well, the difference here, 2 minus 1 is? 1 million. What is that representing?
The profit and loss.
Which profit? The gross profit. Okay, because the gross profit is going to be used in conjunction with other income and expenses in order to get the net profit. Okay, right, net profit is gross profit plus other income minus other expenses. Okay, got that. Right, so here's the note about the different systems. See, I've given you the answers because before you had to actually write them in. Okay, so you told me what was happening. Right, so obviously if I'm buying stock, what type of accounts? Buying stock, inventory. Okay, if I'm using perpetual, is inventory?
No.
Yes, inventory is inventory
Yes, sorry, yeah.
with perpetual.
Yes.
So I'm going to debit the inventory and credit the bank or the creditors.
Yes.
Okay. Right, returning merchandise or stock. I'm not always happy with the stock that I buy. So if you do return goods, you're going to reduce the inventory. Do you agree? Okay, so inventory will be decreasing. Right, the important bit is the why. Okay, why we're doing things. Right, next bit. What system here? Perpetual. Except we're looking at not the buying of stock, but the selling. Right, so if I'm selling stock using perpetual,
I'm still writing.
okay, are you okay now?
Yes.
Alright, so if I'm selling stock using perpetual, what am I going to do? I'm going to record the sale. If I'm keeping track of all the stock that I'm selling, will I have cost of sales? Definitely. Right, so this is actually the very important bit because this is new. This you haven't seen before. Okay, we've discussed it, but previously this might be new in terms of the inventory. Okay, so we're looking at the cost of sales and the inventory. Right, cost of sales is an expense, inventory is an asset. Here's the selling of stock. So if I'm selling stock, goods going in or out?
Out.
Good. So inventory going up or down?
Down.
Exactly. So inventory will decrease and cost of sales will
Increase.
increase because you're recording an expense. Okay. Right, still periodic, not periodic, still perpetual, not periodic yet. This is the sale, return. Okay, so if I'm getting something back from my customer, what is that doing to my books? Increasing or decreasing my stock?
Increasing.
It's increasing my stock. So I'm going to debit inventory
Okay.
and then credit cost of sales.
Okay.
Okay. Sales returns and bank or debtors will be affected when you have the actual return. Okay, notice how it's a two-part transaction, right? Because when you buy stock, you need to record it. When you get stock that comes back in terms of a return, you need to record it. Right, and I'm obviously reversing out the sales because I no longer sold. Okay, what type of account would sales returns be?
Sorry, say again.
What type of account would sales returns be? A sale is income. So the sale return would be?
Expense.
Exactly. Okay, good. What's wrong?
Why is the sales return?
Sale is what type of account? Sales.
It's income
So the return would be seen as?
as an expense. Okay, now I'm with you.
The opposite. Okay. Returning stock, merchandise or goods bought. What happens to my stock? Decreases. Okay, so this is the buying of stock using periodic, and this is the returning of stock using periodic. Right, notice the keywords are purchases. As long as you've got the word purchases, then you're on track in terms of identifying this as perpetual or periodic. Which one?
Periodic.
Periodic, important. Right, so if you know it's periodic, then you know you're going to apply what? Cost of sale equation. Okay. Right, so if I buy goods, I can either buy goods using cash, or I can buy goods using credit. If I use cash, bank will be affected. If I use credit, debtors will be affected. Okay. And I'm obviously going to affect the sales. Right, if I'm looking at the cost of sales, why is this only a one-part transaction and not two? Do I record the cost of sale?
Yeah.
No. I calculate the cost of sale, but when do I do it? Only at the end of the financial year. Okay, so at the end of the financial year, or at the end of the month, I'm going to do a stock take to count how much stock is available inside the business, and that's going to give me the closing stock figure. Okay, then obviously what I buy plus what I started with minus what I ended with is going to give me the cost of sales. Okay. Which account do I use? Buying and selling. Okay, will a service entity have a trading account?
A service? No.
Why not?
Because it's trading.
Not selling a product,
Yes.
only selling a service. Exactly. Okay, so this is what the T account looks like for this trading account. For what type of system?
Periodic.
Periodic. Right, so notice how you're recording those things on the right side. Okay, if I'm going to be, let's say, buying goods, debit or credit?
Debit.
Debit. Okay, purchases will go
Under.
up. Carriage and purchases will also go up. Okay, these are costs that you would have to recover as part of the business operations.
Okay.
Okay, this is something important to remember because you're minusing the closing stock. Okay, closing stock we know needs to be taken out of your purchases. Okay, so example, let's talk about your makeup business. If you buy stock, let's say you buy 100 units of something, and you started with 20 units, and at the end of the year you count and you see you've only got 10 units left. Where did the 110 go?
You used it.
You must have sold it. Okay, exactly. Right, and or used it or sold it, because here we're looking at a trading account. It would be you sold it. Right, the difference. Okay, what is the gross profit for this business? $350. Can I use this to calculate it? Yes, I can. Right, so on that page, you can do it manually. Take the amounts through to this page. Take opening stock, take your closing stock, take all of that through here. Let's see what you get. You should get the exact same figure for cost of sales.
No, wait. Okay, opening.
Put in the amounts in. Write in the amounts.
Is 50.
Yes. Write it down. Purchases.
Returns. Nothing. Closing balance. So it's 150.
Yes. Okay, good. 500 minus 150 is how much?
350.
Yes. Okay, so go back to that page. Just jot that down. 500 minus 150 equals 350 profit. Is that okay?
Yes.
Right, great. Okay, then I've given you a note here about the returns from the customer. Am I going to include a reversal of stock? No. Why not? If I'm counting stock, I'll know how much I have left. I'm not going to process any adjustment. Okay, if people aren't happy and they return the goods, I'm going to have less debtors and more sales returns. Okay, does that make sense?
Yes.
Alright, then I've given you a note about donations and drawings. Donations is what type of accounts? If you donate?
It's an expense.
It's an expense, outflow of benefit. Good. Okay, so what am I expensing here or using? I'm using inventory. Okay, so giving inventory to what do you call them? Non-profit. Okay.
Yeah, but what if you're not giving inventory, but you're giving like money?
Then it would be seen as a contribution. Okay, it could be seen as a contribution. Alright. Drawings?
Okay, so then it will be, so this inventory will be contribution.
No. Inventory will decrease, so that will always decrease. Then you would have contribution as your donation. Okay, contribution is what you're giving. What don't you understand?
Because you're not giving out inventory, you're giving out like, for instance, say my boss gives money every month to people who need it. So
That's a donation,
yes,
but it's a donation of cash.
yes.
So you'll credit the cash, not the donation. So you'll credit cash and you'll debit the donations if they give money. If they give inventory, then they'll credit the inventory. Okay. Right, periodic, you have the opposite word. So you have purchases instead of inventory. Everything else stays the same. Okay, so drawings is either not drawings. Well, drawings, yes. Drawings or donations are either assets or liabilities, income, expenses, capital, drawings, and we're looking at the effects. Okay, what's actually happening for those particular products. Okay. Right, then I've given you some generic steps that you can follow if you're looking at studying accounting, or you can just practice accounting. So if you want to study accounting, then you need these slides. Okay, close of the close of the income to the profit and loss, close of expenses to the profit and loss, and then calculate the profit in order to get the amount that the owner is entitled to. Right, but we'll look at those examples later on when we do past papers and assignment number 2. When is assignment number 2 due? Okay, so these are steps that you can follow in case you're looking for something like profit. Okay, obviously what type of business do we have here? Service. Will the service business have a cost of sale?
No.
No, that's why I only have income and expenses.
Yes. Okay.
Right. Okay, then you've got a note over here looking at trading entities using what system?
Perpetual.
Perfect. If you're using perpetual, will I have cost of sales?
Yes.
Yes, and it will be accounted for separately. Right, there's no need to calculate it because it's given in the question. Right, trading account is used to calculate the gross profit. Income and expenses will affect the profit. That'll either lead to a net profit or a net loss. And then I'm going to be looking at the perpetual. Okay, periodics. This was perpetual. So when I have perpetual, will I have a trading account? Definitely. But how do I account for it? I'm going to have separate line items for every item that I sell. Okay. Here you've got a note about the trading entity when I'm using what system?
Periodic.
Periodic. So if I'm using periodic, what am I going to start with? Opening stock. Okay, we're opening owner's equity, OE. Okay, owner's equity is what type of account? Equity. If it's favorable, it'll have a credit balance. Right, can I have debits here? Yes. What debit would affect those accounts? What debit? So if I'm debiting inventory, what am I doing to it?
You're decreasing.
I'm increasing it.
Yeah.
Okay, so if I'm
Inventory is
increasing
an
it,
asset.
inventory is an asset. I'm increasing it, so therefore it's going to go on the debit side. Okay, so you basically had this earlier. I'm basically just revising what I spoke about in the T account.
Yes.
Okay, this T account.
Yeah. Okay.
Right. Okay, so that's the steps. Obviously, trading account calculates gross profit. Profit and loss calculates net profit. What am I going to need here? I'm going to need the closing stock. That's a very important figure. Where is the closing stock going to go? Debit or credit? Which side? Ooh, the mouse pad. Debit. No. Where will it go?
Credit.
On the credit side. Okay, if your income is greater than your expenses, you'll carry down a profit. Okay. Does that make sense? What's wrong?
No, I lost something.
Lost what? Closing stock on that side, that'll be fine because then you'd bring down the balance. Okay, like what you had here. Alright, closing stock, then all the other accounts. Alright, the difference here is going to give me an amount that's going to be recorded in the books of the business. Where would you record this? Statement of comprehensive income. Okay, you're closing off all the income and expenses and posting it through to the balance sheet or statement of financial position.